Let's first talk about what mortgage insurance is not. Mortgage insurance is not homeowners insurance, also known as hazard insurance. That insurance on a home loan is used for the purpose of protecting your home, for fire insurance or theft, things like that. So mortgage insurance is not homeowners insurance. The difference between the two, aside from that, is homeowners insurance protects you as the consumer, whereas mortgage insurance protects the lender or your servicer, who you're making your payments to. When does it apply, you ask? When you put down less than 20% on a home purchase. One of the big questions we get is, what does it cost? The cost will vary depending upon the type of loan you are getting. Interesting, right? Let's touch on that a little bit. As an example, if you are getting a conventional loan, not a government loan like FHA or VA or USDA, which we'll touch on a little bit later, the cost is associated to 3 different variables. Those 3 different variables are FICO score, down payment, and last but not least, property type. So naturally, if your FICO score is higher, which means that you pay your bills on time, your balances, your high credit limits are probably low, you don't have any open collections, you have a good credit history, right? Then the risk involved from a credit perspective is low, in which case your mortgage insurance should be lower. Next would be your down payment. Now, naturally, if you put more down, right? 10% versus 5%, it's safe to say that if you put more down, you are lowering the risk of that loan, in which case your mortgage insurance is calculated on a monthly basis will also be lower. The lowest risk type of property is a single family residence that is not a townhouse and it is not a condo, okay? So if you have a condo or a townhouse, there's homeowners association dues and other things that come into play, which do what? Increase the risk. If your property is a multifamily, that will also increase the risk for other reasons. So your lowest risk scenario is a single family residence. If you fall into any of those other buckets, just keep in mind that your mortgage insurance could be more on a monthly basis. People often ask, how often do I pay it? You pay your mortgage insurance on a monthly basis, which typically is included into your monthly payment. One of the other big questions we get is, can my mortgage insurance drop off, right? You will find information all over the internet about this, but trust me, double, triple check with somebody that you know and trust, like ourselves, in the industry, so you know exactly what the rules are. But the immediate answer is yes, your mortgage insurance can drop off. But how and when is defined by how much you put down. Are we in an upward trending market? Will your servicer take into account your new value, assuming it has gone up since you purchased your property, combined with whatever you put down on your home? So it is an open-ended question, but there are a handful of things to pay attention to. The immediate answer is yes, it can drop off unless you are financing a government type of loan. A couple things on types of mortgage insurance. Types of mortgage insurance are going to come into play with conventional loans, okay? Otherwise, government types of loans like your FHA or USDA, your VA, all have a set figure regardless of FICO score. Conventional loans have multiple types of mortgage insurance, in which case you as a consumer have to determine which one is in your best interest. Now, how do you define what that is? Talk to somebody like ourselves so we can explain the differences between the types of mortgage insurance. For example, you can have a single paid premium. You could have a split premium. You could have a buyer monthly paid premium. Yeah, the list goes on and it will get overwhelming. So just pause and ask somebody like ourselves as a professional so that we can help you navigate the process and determine what is in your best interest. Because sometimes people go, well, how do I get rid of mortgage insurance if I put 5% down? Is it possible? Guess what? Yes, it is. And we can talk about that more later. But anyway, for now, just know that there's different types of mortgage insurance, in which case we'll dive into a little bit more, and you could also reach out to us. Now, government loans. I promised that I would get back to this. So government loans like your FHA, your USDA, and your VA all come with different set parameters. I've defined a lot of that below because the guidelines are going to change on those set figures depending upon the time of year, if guidelines change, and they're not defined by your FICO score. However, they can be defined by how much you put down in some cases. Can they go away or drop off? The answer to that question more below, but the immediate thing is this. Don't be fooled by the same rules as conventional, because FHA, VA, and USDA, although VA doesn't have a monthly fee, FHA and USDA do. And guess what? They are stuck for the life of the loan, which means until it is paid off, or refinance, which is, guess what? Also paid off. So there is one scenario with FHA that is not the case. It will fall off in 121 months, which is 10 years, assuming you stayed in that FHA loan for the entire 10 years, at which point the mortgage insurance falls off. And that is when you put down 10% or more. Now we're talking about home purchase, not refinance, because the rules are different on refinance for all of these scenarios. Again, reach out to us for more information, but we just wanted to get you the highlights as of right now. So that's mortgage insurance in a nutshell, guys. Don't get mixed up and not pay attention to all the details, and please try not to pay attention too much to a bunch of the mumbo jumbo and all the stuff that's out there that may be incorrect. I'm trying to cover my basis as best I can, and I'm probably not even covering it all. But just keep in mind that it's very convoluted. There's a lot of rules. There's a lot of little tips and tricks and more and things that come into play with FICO scores and what type of loan you're going with and how much down, and should you put less or more down and put some of this extra money over here and buy out of mortgage insurance. It's a lot to think about. Leave that information to us to help guide you, right? Use our links that we provided to go and do some research on your own. And if you have questions that are specific to anything in this video, please reach out by means of putting some comments below or DMing me or texting or calling, as we're happy to help you navigate the process. That's why we're here. We love to help educate people and just give information so that you can make the decision. This isn't our decision. This is your decision. We're just here to help navigate the process. Good luck. We'll talk to you soon. Thanks again for tuning in. And until next time, we'll talk to you. Take care.